It's been a pretty underwhelming week so far for the Australian market, but maybe that'll change across the next few days. So hi everyone, welcome to the Traders Circle weekly market update. Today is Tuesday the 19th of September, and before I begin, and as always, you do need to be aware that anything I say is general advice only. So it doesn't take into account your particular circumstances, and you have to decide if it's appropriate for you. The big news this week is the Fed. The Fed will meet on Wednesday night, Thursday morning Australian time to decide on interest rates. Now, it's almost certain that they're going to keep rates on hold at this meeting. The real discussion will be around whether there are more rate rises in the future. At present, the FedWatch tool is basically suggesting that there's a 66% chance, a two-thirds chance, that we're already at peak US rates, that there's going to be no more rate rises this tightening cycle. Now that would be a pretty good thing for markets, but many in the market, led by comments from Fed members themselves, are saying that though rate rises might not be on the agenda, we may see higher rates for longer. So that could be a bit of a shift in tone at this meeting, away from further tightening if necessary to higher rates for longer. And that's going to be something that people will be looking for in the commentary and looking for in the dot plots. At the last meeting, at the previous meeting, the dot plots were still suggesting more rate rises moving forwards. At this meeting, they might bring it back and they might suggest that there are no more rate rises, but they might push out the rate cuts on the dot plot. Now, whether that'll be positive or negative for the market, it's hard to say. I suspect it's not going to be super positive, especially if they push out the rate cut timetable on the dot plots. So we will have to watch closely to see what that meeting holds, see how it affects, the rate rise probabilities. Like I said, probably not going to be a rate rise this meeting, and it could be that we're already at peak rates, but we might see the market reprice, the rate cuts in 2024. It might push them out towards 2025. The other thing to note on this front is we will see European CPI tonight. That's expected to be slightly lower than the last few months. It is coming down very, very slowly in the Eurozone, although in many places of the Eurozone, it's not really coming down at all. Now, one of the reasons why CPI growth is still very, very strong, and in fact, it looks to have sort of bounced a little bit over the last few months, has been the very strong movement in oil prices. We're going to touch on that in a moment, but already we're starting to see central bankers, Fed members, the RBA in their minutes today start to say that with oil prices rising as they are, it could lead to further inflation in other things. You've got to consider how important oil is, not just for, transport industries, but just about every good and service that you can buy. Whether it's a direct cost, whether it's an indirect cost, the rebound in oil prices is pushing up the cost of many of these goods and services. So oil prices are the next thing I wanted to touch on. They're up roughly 35% over the last 3 months. They've basically found a bit of a low in the middle of this year, and then they've bounced back up towards the peak of November 2022. That is a pretty big move in oil, like I said, 35%, and that's really sort of causing some of these central bankers to scratch their head and think, well, maybe our battle isn't done just yet. Now, central bankers may be able to reduce demand for oil by slowing economic activity, but they can't increase supply for oil. And when you've got OPEC members cutting production, Saudi Arabia, Russia, and trying to push prices back up, it's a really sort of difficult balancing act for, Western central bankers to try and, wrangle prices back down. So that is something to watch. We do want to watch the peaks, and we'll look at them in the charts in a minute. We do want to watch the peaks from November last year, and we do want to hope, at least if you're bullish, you want to hope that the prices don't exceed those levels. Finally, I wanted to touch on the Australian underperformance. It's been a pretty lackluster week for the Australian market. We did have a pretty strong showing on Friday last week, but we've reversed all of those gains, and really we've done not an awful lot for the past month or so. In fact, if you stretch it out over a longer term period, we've done not much for the last year or so. So if you actually look at us compared to the US markets, we've underperformed over pretty much any period. This year they've had a bit of an uptrend that has stalled out over the last few months. But even as their uptrend stalled out, we've performed just as bad, if not worse at times. So you could point to perhaps our diverging interest rate view. Here in Australia, we are still expected to see one more rate rise at some point in the next 6 months. That's according to the bank bill swap rates, whereas the US is expecting that they're already at their peak. The other divergent thing might be just how important the Chinese economy is for the Australian stock market, with a perceived slowing in the Chinese economy. Although recent Chinese data has been a little better than expected. Finally, and particularly recently, we've also seen some large dividends be paid out of the Australian market. Certainly many more dividends proportionally than the US market, and that does take points off our market as well. So we'll have a quick look at the charts and we'll see that underperformance, and we'll have a quick look and see where things might head. So this is the Australian XJO, the top 200 largest listed shares in Australia, and we can see it's in a giant pennant pattern. We've got a longer term uptrend that's formed since the lows of 2022, and we've got a short term counter trend from our peak in July. So at the moment we just look to be heading into the point of this pennant, and in terms of key levels that I'd be looking at, there's this downtrend line currently sitting maybe 72.75, and the uptrend line currently sitting maybe 71.50. Should we break that uptrend line, there's plenty of support around here, 71.30, 7100 roughly, and then if that breaks, the key 7000 level. Should we push to the upside and we break above that downtrend line, there's additional levels of resistance at 73.15 I should say, and 73.60. If that breaks, we might head back towards the yearly highs. At the moment though, for our market, it looks like we're sort of treading water, waiting to see what the US data looks like, waiting to see what the Fed looks like, waiting to see what our own data looks like before we commit to a directional move. So just at the moment, we look a bit more sideways as we head into the point of the pennant. Looking at the US market, they've had a very nice uptrend for the last sort of 12 months now almost. They did top out a bit in July as well, and importantly, they have set a couple of lower peaks. So technically, this is a start of a bearish signal for me on the US market. We had a lower peak here in late August. We've had another one over the last few days, and I would be keeping a very close eye on this market for the next few sessions. I'd want to see the S&P 500 push back to at least 45.50, because otherwise it will be looking like we've got some a downtrend starting to form. The key level to the downside, they're right on it at the moment, is 44.50. Should that break, we should see a move back towards 43.50. At the moment though, just like the Australian market, there isn't a clear signal. We're waiting to see which of these lines break, waiting to see which way things head. As I mentioned before, the sort of key cause of concern for central bankers at the moment is this oil price. Since the lows of June, it's up over 35%, and it's moving back towards the peaks of November. Should this keep rising, the battle against inflation is really sort of reignited. It looked like central bankers were getting a handle on it, and then this has happened. The more this oil price pushes up, the more the price of many other goods and services will push up, and the battle for inflation will reignite again. So if you're a central banker, if you're a bullish investor, if you're a consumer, if you're just about the majority of stakeholders, you will be hoping that oil goes no further than these peaks from October and November last year. So that's roughly $93 a barrel for West Texas Intermediate crude. It's getting very close to that level now. So that's it for this week, guys. I will wrap it up here. Hopefully you enjoyed. If you did, give us some love in the comments, click the like button, click subscribe, and we'll see you in the next one.